The next step in monitoring and risk management is that we have to check ourselves all the time in order to make sure that these assumptions that we made regarding income and also regarding expenses, that these assumptions are still in force. Okay? There is a tendency, I think it's a human tendency, but I saw it mainly with CEOs, directors of organizations, to be confused between a plan and what actually happens. So people sometimes, I hear something like, I know exactly what my salary expenses will be because I planned it and I have a budget. So this is a wrong statement. The only thing we know for sure about the future is that it is unpredictable. All the rest are just speculation. And there are things that happen all the time. And if you check yourself, projections versus what actually happened, you will always find deviations. Okay? So in order to monitor our assumptions, we need to compare actuals that come from the accounting system versus plan. Okay? And this is the basic budgetary report. That is a report that compares what we plan compared to what actually happened, and then we ask the question, are there deviations? And if there are deviations, or there are always deviations, what is the explanation? Okay? Now, before going into the format of the report, it is important to distinguish between two risk factors. So first of all, let's define the risk. What is the financial risk that we face as an organization? No different from the financial risk that we face as individual. The risk is that we will not be able to fulfill our obligations. That at a certain point of time, we find that there is not enough money in the bank to pay salaries, to pay suppliers, to fulfill all our commitments. Once we are in a situation like that, the formal definition is bankruptcy or default. When an organization or an individual cannot meet her, his, or its obligations, financial obligation, then it is a situation of default or financial collapse. That is the risk, and this is what we want to avoid. Okay, when we say that we want to keep our organization safe or stable, it is to avoid this situation of default. Now, the financial risk of not meeting our obligation or default can be the result of two different, you can say, phenomena. And that is the most important thing to understand in this area of risk management and how we use our budget for monitoring. The first factor that may cause financial default is a budgetary risk. What does it mean here, budgetary risk? Let's take a very simple example. Suppose that we anticipated or projected income of $1 million, whatever, dollars. And based on that projection, we start to spend, or we approve the budget of $1 million. So we have $1 million projected income and $1 million in planned expenses, which are reflected in our budget. Now, if in the course of time it so happens that the $1 million of projected income will not materialize due to all kinds of reasons, we will receive only $800,000, then it is a certainty that at a certain point somewhere towards after the middle of the year, we will be in a situation in which we will not be able to meet our financial obligations. Okay? Not enough income. Just to translate it to a very individual, simple example, suppose that you took a mortgage and in the mortgage you have to pay every month, I don't know, 2,000 shekels payment. And that is based on the fact that you are employed and you make 10,000 shekels as your salary. Now, if at a certain point you are dismissed and you don't have any income, then for sure you will not be able to meet your financial obligation. So budgetary risk is the risk of over-optimistic assumptions, mainly on income. Usually our miscalculation or over-optimistic assumptions will be on the side of income. And the reason is that expenses are easier to predict. We can predict our expenses and we also control our expenses. We can decide how many people to employ. However, we cannot control the income. We project, we hope that we will receive the money, but we don't have any control over that. So budgetary risk represent over-optimistic assumptions, and the only solution to this kind of risk, if we find out in the middle of the period, right, we planned for a year and suddenly we find out that we are not going to have enough income, the only solution is to decrease the expenses, okay? Apart from raising more income. But if we can raise more income, then the problem does not exist. But if the situation is such that suddenly we realize that we are not going to receive the income that we planned, then the only solution is to reduce the expenses, to decrease the budget, to dismiss people, to close programs, and all the things we discussed when we talked about recovery plan and stuff like that. Now, even if our budget is still balanced, or even if our budgetary assumptions are still okay, we still may find ourselves in another type of risk, which is a cash flow risk and relates to timing. Now, the issue of timing is that income and expenses are not synchronized, which means that expenses are usually spent with like quarters. Each month we have to pay salaries, each month we have to pay our suppliers. They are usually on a monthly quarters. Sometimes there are seasonal expenses, like in the summer camps and stuff like that. In the income side, there is no regularity. Okay, some income sources have certain regularity, like if you have a contract with the government, then you receive monthly payment. But if you are based partly or only on donations, there is no regularity in donations. And it may happen that the donation that you built on, that you projected, is secured. You will receive the money. However, you will not receive it in time to meet all your obligation. Okay? And that creates another type of risk, which is cash flow risk, and relates to the timing of income coming in versus expenses going out. Now, the reason that we need to distinguish between these two factors is that the solutions to each one of them is different. While the solution to budgetary risk is decreasing expenses, obviously you will not decrease expenses if you have a delay in income. If you do that, you will not receive the income at all. Okay, think of a situation in which you have a grant and the final payment is only after you submit the final report, which obviously will be next year. Now, if you have a timing issue and you will not make the expenses, you will not get the money at all. So the solutions for cash flow risk or timing is either trying to receive advance payment on account of your guaranteed income, of the grants or whoever are your sources, Or the more common solution is delaying your payment, paying your suppliers later. What is called in Hebrew shotef, if you know that term, which means I receive the service now, but I will pay only next month, the next 2 months, the next 3 months, and whatever. Another way to solve the timing issue is to try to receive some kind of bridge loans, which are short-term loans that you receive just to cover your current financial needs, and you repay the loan immediately after you get the secured income. This is more difficult because banks are not very enthusiastic to supply loans to non-profits, but there are some foundations who are willing to do that, to provide kind of bridge loans. So when we monitor our risk, we have to be certain what type of risk we are facing in order to apply the correct measures. Because if we don't have the correct diagnostics, we may use the wrong solutions. In a way, it's like in medicine. First of all, you have to diagnose the problem, and only then you can apply the medicine. If you don't do that, if your diagnosis is incorrect, then the medicine may cause more harm than good. So this is basically what we need to do. We need to monitor our organization and ask ourselves every time, are we at risk at all? And if that risk exists, is that a budgetary risk or a cash flow risk? And I want to show you a very simple system, how we do that, okay, which you can apply to any organization. And basically, it follows certain steps. And in order to see that, we'll go to our Excel file, and we will go to a worksheet which is called Dynamic Budget. Okay, so what do we see here? A lot of numbers, right? What to do? What we see here is a budgetary report of these are obviously real numbers. This is a real organization. And we'll try to get a sense what we see here. So first of all, to remind you, I showed you already a budgetary report when we talked about the fund accounting. And I told you then, this is a budgetary report, compare actuals to plan, and we will get back to that. So now this is the time that we get back to that. So first of all, if you look at this report, which is unlike all the reports, unlike all the budgets that we saw before, it presents separately income and expenses. You can see the first block relates to income, and then the second block relates to expenses. And this is unlike the economic map and everything that we saw until now. Now, it is not a necessity to present the report like that. It is just easier, since here, when we do the risk management, we want to look separately at income and expenses, okay? And specifically, since usually the deviations, the significant deviation will be in income, we want to see the income block separately. Then, once we have the title, we have the different programs, program A, program B, program C, D, and the unrestricted income, okay? A, B, C, D, and E, and the unrestricted. And for each one of the programs, we see the different sources. Like program A has income from government, fees for services, other government. And if you go a little bit backward, you will recognize that this is basically the same organization that we saw in our first example, the economic map. Okay, this organization with total income of 11.614. So, see, 11,614. This is the same organization. This is the budgetary report for this organization. Okay? Now, so we see the income block, we see the programs, and when we go to the expenses block, the same thing. Here, the expenses are divided only to their main source of spending, salaries and activities, which refers to all the expenses which are not salaries. We don't need a detailed report to do an overall risk management to our organization. Okay? That report on the aggregate level will be enough. All right, so, and again, program A, B, C, and the fixed cost, each one is divided to salaries and activities. Now, another piece of information which is important is the date, which means this report relates to what period. Okay? Now here I will discuss accounting system that works on a calendar basis, but the same principles can be applied to accounting system that works on school year, university year, whatever. When we work on a calendar basis, the year starts in January 1st. Okay? And our accounting system will show us a report which is called a trial balance, which always will show us the accumulated income or expenses from January 1st until the last date of the month that we choose, providing, of course, that we have data. So each month we have to produce a report like that, which will relate to the period of the previous month. This report is for July. That means that this report was produced somewhere in August when all the expenses of July were recorded in the accounting system. So it relates to how many months? If it's for July and began in January, how many months do we have between January and July?
6.
7. The end of July, January 1st. Okay, July is the 7th month, so this report is for 7 months. But the same report should have been produced to June, to May, and should be produced to August. Each month we produce a report like that. Okay? Now, the first column is the budget. So the budget is exactly the same budget that we saw in our economic map. This is the budget of each one of the programs. Now we relate only to the income side. Okay? And then we will go over, we will move to the expenses. So this is the projected income for program A divided by government fees for service, and then program B, program C, etc. And this is the unrestricted income. This was our projection. Based on this projection, we approved the budget. Okay? Now the budget is presented in annual terms, which means this is the budget for the entire year. Okay? Now we have the second column, which is titled utilization, because we use the same title for both income and expenses. Utilization, or actual, sometimes you can say actuals or utilization, either income utilization and expense utilization, or actual income and actual expenses. So this column is the actual income that was received and recorded in the accounting system for the period January until July, meaning the first 7 months of the year. And obviously this is just an example. The same report should be produced each, apart from January, that is, it's not very relevant yet. Starting for February, let's say, we need to produce reports like that. Okay? So, for example, we can see that in program A, we received 990,000 and something shekels, and for fees for services, 1.3 million altogether, for program A, 2.3, etc. Okay? Now, based on the plan and what actually happened, we now want to try to assess our situation. Okay? So these are budgetary data. These reflect our projection. These are actual. In terms of how this report is made, budget is obviously entered manually. But this part comes from the accounting system. This is not something we can change. Budget we can change because it's a plan. We can always change the plan. These are actual. This is history. It happened already, and we cannot change the past. Okay? So the first thing that we do is in this column, which has percentage, we divide the actual by the plan. Okay? We divide the actual by the plan, so we can see that, for example, in the government income, 58.3% was already received. Then in fees for services, 55.6% received. Okay? Now, there is a very simple benchmark that helps us to distinguish between sources with issues and sources which have no issues. And remember that this is a small organization, but sometimes we have to deal with large organizations with very detailed budgetary reports. So the key here is to be cost effective, not to spend time on things that are not, there is no need to check them, and to spend enough time on the potential issues, potential problems. So the elimination method is to compare the utilization rate to standard utilization. Now, what is standard utilization? It's a very simple benchmark. Basically, it shows us that if income would have been received on with a constant pace, the same amount each month, what will be the utilization rate in this case? And this is calculated simply by dividing the number of the month by 12, due to the fact that I hope you remember from previous course that there are 12 months in a year. Okay, and if you don't remember that, write it down. By the way, in old times there were some kind of calendars with different months in a year. Okay, so since we are in July, this is a report for July. July is the 7th month, which means this is a report for 7 months. 58.3 is 7 divided by 12. Okay, so what will be the utilization, the standard utilization for June? June, 6 months, it will be 6 divided by 12, 50%. And June is exactly half a year. Okay, and then September will be 75%, August will be 2/3. Each month adds 8.33. Okay, because 1 divided by 12 is 8.33. Okay, so now I can look at my utilization rate and I look for significant deviation. Again, the emphasis here is on significant. Obviously, this is reality versus plan. It is always dirty. There is never an exact match. But if it's in the area of the standard utilization, then I don't have to worry about it. So for example, I have here, you can see 29.6. This is very far from 58.3. And if I look on the other side here, I have a higher number. Now, in terms of income, which is preferable, or what is better for me? Higher utilization rate or lower utilization rate? Yes, Sophia.
It's better to have more, so you're more flexible.
True. So when I look at income, then lower utilization rate represent income which is lagging, does not come as planned, while higher utilization rate is it's more than the plan. And if you take it to the extreme, the best case scenario for any organization is to get 100% of the income in January 1st, then we have all the money in the bank, and then we can spend without having to worry about financial risk. Unfortunately, it never happens. So, therefore, there is employment for people like me to discuss risk management. Okay? So we look at the deviations, and mainly in income, we look at the lower utilization rates, and where we may find problems, like here, okay, maybe even like here, okay, where the utilization rate is significantly lower compared to the standard utilization, okay? Now, before moving to the periodical budget, to the next column, let's see the same thing about expenses. Now here, in order to keep the consistency of the numbers, we have to show expenses with the correct sign, which is minus. Okay? Just to, I think I said that already, but I will repeat. In your accounting system, you will find two columns, credit and debit. Income will be in credit, expenses will be in debit. Basically, you can translate credit to plus and debit to a minus. Credit comes in, plus, expenses go out, minus. So the budget and the expenses here are marked with a minus sign, and you will see immediately why it is crucial for otherwise the table will not work. So here I have again my budget, that is the first column, the plan, and in the same way I have the actual expenses, January until July, 7 months of expenses, and again I have the utilization rate. But when we look at the expenses, what we look in the utilization rate is exactly the opposite. If we have utilization rate which is higher than the standard, it means that spending exceeds the plan, and that is not so good for my cash flow. Okay? It may be justified, but it's not so good for my cash flow. On the other hand, if the utilization rate is lower than the standard utilization, which means that spending is below my plan, it may not good to my reporting to the donors, but from point of view of cash flow, it has a positive effect. I delayed my expenses. So again, the utilization rate can be used to assess where we are in terms of expenses, but in the opposite direction. Now, is this clear, the issue of the directions? Okay, in income, it is better for us that more income will come compared to the plan, while in expenses, it is better for us, again, from point of view of cash flow only, that less income will be spent compared to the plan. Okay? All right, so this is a very simple benchmark, but now we want to take it one step further, and we want to see the effect of these deviations not only in percentage terms, but also in monetary terms. And we will see in a minute why it is important. So in order to do that, we calculate here a column which is called a periodical budget. So what is the periodical budget? Let's look at the formula which is here. So the periodical budget is the multiplication of the standard utilization by the annual budget. What does it mean? It means that if the plan was, the budget, the projection was to receive 1.7 million from the government, and in case everything was linear, which means in a constant pace, then at the end of July, we want to have 7 divided by 12 of that income, or 58.3 of that income. Okay? Again, I will repeat it. The periodical budget basically shows us what should be the income that we need to receive so that by the end of July we will get exactly, in this case, 58.33. Okay, so the periodical income, for example, in June will be 50%, and the periodical income in September will be 75% of the annual budget. Okay, is this clear until now? All right, and then the next step is to calculate the deviation. So let's look here. Here we have, in fees for service, we have 2.357. That's the annual expectation that we planned on. We received 1.3 million, which is 55.6, not so far from the standard utilization. However, if we calculate the periodical budget, 58.3 out of 2.357 is 1,374,000. And now, when we calculate the difference between the actual and the periodical budget, we receive a deviation of minus 64,000. Now, note the exact correspondence between the deviations in percentage and the deviation in numbers. In income, in the income block, if the actual utilization rate is lower than the standard utilization, then the deviation will be negative. That is the missing income. The income we wanted to receive this amount, we received only this amount. Yes, Christian.
And the deviation is projected, right? It's not real.
No, it's not. It's true. It's not a real deviation. It is a benchmark to assess what type of risk you're facing. Okay? That is the role of this deviation, and then will be clearer when I'll explain the process. Okay, so you can see why we need the numbers and not only the percentage. Because look, for example, here, fees for services, we have a very low utilization rate. 29.6 compared to 58 is very low. But since the amount which is projected is small, the translation of this deviation to monetary terms is only 30,000 shekels. While here, the utilization rate is much closer, still lower, but much closer to the standard utilization, but the difference here, which is not much in percentage, translates to a significant amount in shekels or in monetary terms because of the size of the budget, of the projected income. Okay, small percentage out of large amount can be more significant than large percentage of a small amount. All right, this point is clear? Okay. Now, so we calculate the deviations, and we have a table, and here again the deviations are marked red for negative and black for positive. This is just for visualization, so that will be clear. And we do the same in expenses, but in expenses, let's look at the example here. Activities budget in program A. Okay? The budget is 1,266,000. Minus sign because it's an expense. We spend 651,000, which is 51.5%, lower than the utilization rate. Okay? Now, in expenses, lower than the utilization rate is better from the point of view of cash flow. It does not put pressure on our cash flow, you can say. Now, if we translate that using the same formulas, so our periodical budget would be 58.3% out of the total is 738,000, and we apply exactly the same formula, which is actual minus periodical budget, we get a deviation, but this time it is positive. This time, the lower utilization rate is translated to a positive monetary deviation, which means that if we spend less than the plan, then our bank account will feel more comfortable. Okay, less cash will come out. All right. So this is the reason why we have to present the expenses with a minus sign. If the sign of the expenses was positive, we would have to change the formula. Okay? If we want to keep the same formulas for income and expenses, we have to use plus for income and minus for expenses. So this is basically the construction of the table, and obviously if you want to use it in your professional life, you can use this table as a template. Now what do we do with that? So before going to what do we do with that, is the table clear technically? Yes, Mu'tasim.
What if a certain program is happening over, let's say, 3 months period of time? Do we still do this?
Again, I couldn't.
What if a certain program is happening over, let's say, a 3 months period of time? Do we still do this analysis?
You mean what we talked in the previous class about?
No, this one. Like if it's not, for example, program A is only happening between July and...
Okay, all right, yeah, okay. So that's a legitimate question, and I think we will see the answer in at the end of the discussion, but your point is correct. This analysis relates to programs that go, or expenses that are spread over the whole year, like our fixed expenses. Now, if you have programs that, let's say, end at, suppose you have a program that starts in January 1st in this year budget and ends at the end of August. So now you have to compare the utilization not to 7 divided by 12, but to 7 divided by 8. Okay, so the principle is the same. It just becomes a little bit more complicated. So you have to apply. I have, for example, in one of my organizations, I have programs that have different time spans. One is from January to June, one is from January to September, one is calendar. So for each one of them, you have to create a different standard utilization and then compare the actual. Okay? So it's the same principle, just a little bit more complicated. But the principle remains the same. Now, let's stay with this simple example of annual programs. And now, how do we use it? What do we do with these numbers? So, first of all, let's start with the income. We look at this column and we try to sort it by the deviations from large to small. So if we look at the sources of the deviation, we can see that the largest deviation is here. Here we expected to receive from unrestricted donors 955. We received by the end of July only 290, which is 30%. And if the income would come in a constant pace, we should have received 557, so we have a deviation of 266 with a minus. Obviously, we look at the minus side. The plus may be interesting for other purposes, but not for risk management. Okay? Then after that comes this one, which is government for program B, and then I believe it will be this one, and then this one. The small ones are insignificant. We don't have to deal with them. So this one may be on the verge of significance. Okay, so I have now a tool that tells me what I need to check. I need to check here, this line. I need to check this line. And also it is advisable to check this and this. Okay? All right, so now I have a screening tool. What needs to be checked? And then if I go to the expenses, you can see that the expenses First of all, deviations are much smaller. That can be predicted because the expenses are under control. And we may want to check, let's see, here, in activities. What happened here? Why we have overspending in activities. Okay? Now, once we identified what we want to check, we apply the process that is described here. Okay, and I will show you an example with these tables how it's being done. So the first thing that we want to know is whether we have a budgetary risk or a cash flow risk. And in order to know that, we need to check the budgetary assumptions. Now, the check of the budgetary assumptions is not, it is outside the scope of the financial reports, which means the financial reports will not tell you what actually happens. You have to go to the people who are responsible for these incomes. For example, here we have a shortfall, a significant shortfall in the unrestricted donation. Now this amount, 955, probably has some kind of detailed sources. We applied to this foundation, we applied to this donor, we projected income from whatever. We need to check source by source and ask the following questions. Today, in the end of July, let's say mid-August when we have this report, are the assumptions still valid? Do we still anticipate to receive by the end of the year this amount? This is the most crucial question. Every month we have to identify the income items that have deviation, negative deviation, and ask the questions, are the assumptions still valid? Okay? And again, this is not something you can see in the financial reporting. This is something that you have to ask your fundraisers, the people who actually submitted the request. Are we in contact with these donors? Why the donation is delayed? Now, there are two possible answers. One is that everything is okay. It is just a delay. Okay? The program officer did not sign on the document, all kind of, but there is no risk that the money will not be received. This is answer number one, and if we get that, then there is no budgetary risk in this item. However, if the answer is, oops, this amount will not be received anymore, the donor have regrets, they change their mind, they change their policy, and this money will not be received, then we have to adapt or change our budget accordingly. Okay? So the check here on the income side, and that is the most crucial check, is to check the budgetary assumptions and ask the questions, is there any change in the assumptions? If there is no change, the assumptions, we think that they are still valid, it's just a matter of delays, then we are in the arena of the cash flow risk, the timing issue, and not in the arena of budgetary risk. Now, the same applies to the expenses. For example, when we see here that activities is in overspending, the question is, are the assumptions regarding the activities still in place? And it's just overspending because, for example, most of the spending was done in the first half of the year and the second half will be, so no problem. Or we look and say, oh, we missed here, we approved activities that we didn't budget and we have a mistake in the budget, we have to adjust the budget. So this is basically the process of you can say discrimination between budgetary risk and cash flow risk. And as I said, if after we checked there is no concern that the budgetary assumptions have changed, then we can move on, and we only have to deal with the cash flow issue, meaning that, if we have delayed income and we cannot get it faster, we will have to delay our expenses, go to our suppliers and pay them later. But I want to show you a full example of what needs to be done in case we have a budgetary risk. Okay, and that is an example that we have here in the Excel file, and also, in the Excel file. We don't have it here. It contains 3 stages: check the budgetary assumption, then update the income budget, and then update the expenses budget. So let's see this detailed example. Okay, so you see here a demonstration of the dynamic budget. Phase 1, check the budgetary assumption. So the story here, obviously this is a story that I'm telling here in order to create an example, is that after reviewing the assumption, it became clear that unrestricted donation will decrease by 500,000 shekels. Okay? So let's clarify. We reviewed all the deviations. Everything was basically, we received the check. It's okay. The assumptions are okay. It's just a delay in income, or in case of the expenses, just a temporary overspending because we have more expenses at the beginning of the year. But we found one thing that was clarified by the end of July, and that is that out of the 955,000 unrestricted income, okay, out of that amount, suddenly we realized that 500,000 will not be received. A grant that we were sure that will be received, and at the end of the process, the foundation changed its mind, whatever the reason. Okay? All right, so what do we do? And I want to show you that step by step so that it will be clear. The first thing that we need to do, and that is phase 2, is to update the income budget. Now, this is the reason that the whole topic here is called the dynamic budget, something that is really straightforward, but people find it hard to accept it, not to understand it, and that is that the budget is not curved in stones. It's not something that we received from higher sources and we have to obey. It is a plan that we made, we human beings, in a certain point of time. And if the assumptions of the plans are incorrect, we have to change the plan. Okay? This is what a budget is. It's just a plan. And plans have to be adjusted to the reality. So we need to look at the budget as a dynamic thing and not as a static thing. And the first thing that we need to do is to adjust our income projection. So this is shown here in the next table. And the kind of gray-yellow mark the changes. So the table here in phase 2 is identical to the previous one, except for the fact that here, instead of 955, we have 455. Okay? So we took out the 500,000 that now we realize that will not be received. So what happened? The table now looks exactly the same. The only thing that happened is that now the utilization rate is higher than the standard utilization, 63.9, and instead of a negative deviation, we have a positive deviation. So it seems like we created a magic and the problem is solved. But obviously this is not the case, because what also happened was that in the base scenario, in the first report, we had here a surplus, a planned surplus, okay, of 604,000, which means that when we planned our budget, we planned it with expenses that are lower than our income, so that we will have a surplus of 600,000. Now, if this surplus is just to increase our operating reserve, when we deduct 500,000 from the income, obviously the surplus will be reduced by 500,000. Okay? So the problem, let's say, disappeared from here and moved to here. Okay? It was just shifted from the deviation line to the bottom line. So now we have to ask ourselves, can the organization live with a surplus of 104,000? Now this is not a straightforward question because it very much depends on the initial conditions in which we enter the budgetary year. If we enter the budgetary year with operating reserve which is positive or even zero, then yes, we can reduce our current surplus and just have a smaller operating reserve. But if this surplus was planned to, let's say, repay debts because we have a negative operating reserve, and that brings us to our previous discussion about the initial conditions, then 104,000 may not be enough to meet our financial obligation. And again, in order to make this example complete, I am showing you a scenario in which this is not enough. So once we check our situation after phase 2, we see that the organization actually planned this surplus to pay debt. For this organization, by the way, it's the true situation. The organization was took loans from the bank to cover negative operating reserve, and it had to repay its loans. Now, loans usually will not appear in the budget because they are not reflected in the accounting system, but we have to take them into consideration. So when the organization looked at the amount which will remain after the reduction of the 500,000, it found out that it's not enough. The story that I'm telling here is that the original budget included a surplus of 600,000 shekels for loan repayment, 300 for this year and 300 for next year. So the organization tried to create a surplus to repay the loan for 2 years. And this year, already 150,000 was paid, so there is an additional 150,000 to be paid, and 104,000 will not be enough. Okay? So now we have a situation in which we updated our income budget, and we found out that there is a budgetary risk. Okay? And that is exactly the definition of budgetary risk, meaning that if this organization, in order to meet its obligation, has to be with a 150,000 plus, and the budgetary table or the budgetary projection shows a surplus which is lower, it means that we are in a budgetary risk. It means that we will not be able to meet our financial obligation. Okay, and I'm on purpose showing you an example which is not clean. Clean example will be balanced budget, and then we will have a deficit. But in reality, sometimes we plan for a surplus because we start with a minus, with a negative operating reserve. Okay? So now comes the difficult part from the point of view of management, and that is we have to take measures to decrease our expenses. Okay? Now, when we need to decrease expenses in the middle of the year, it is different from planning for lower expenses. We saw when we discussed the budgetary scenarios and recovery plans that when we plan for the next year, we can decide to close the program, many things we can decide to do. But when we are in the middle of the year, so first of all, 7 months of spending already happened. That we cannot change. So even if we close a program, we will not be able to save the entire cost of the program, but only the remaining month. Also, an organization, I quote the director of Hadassah Medical Organization at the time, used to say that Hadassah is like a big ship, and it takes time. From the time you turn the wheel until the ship turns, it takes some time, which means that these changes, they take time. Even if you decide to close a program, then you have to dismiss employees, and you have to call them for a hearing, and then you have to send them dismissal letter, and then you have to wait a month. And so it takes time to shift an organization. So the first candidate that we should look for decreasing expenses in the middle of the year will be one-time expenses. Usually the first candidate will be any spending that we plan on fixed assets. So if we plan to replace all our computers, we can postpone that to next year and still work with the old computers. Or if we plan to have a, big event at the end of the year, so we can postpone that and not have this event. And here in the example, the management decided for this year to cancel the development budget for new programs. Development budget is usually a one-time, you pay a certain consultancy, so we will not spend this, we will postpone it to next year, and we will decrease the training budget, which is also, it's usually called soft cost. So the idea here is that we try to decrease our expenses budget, but we try to minimize the negative effect on the organization by trying not to dismiss people, not to touch the staff, and to, if it's possible, of course, and to take all the soft costs that we can cancel. So here is, this example is what we see. So we create total saving of 50,000, and let's see that in phase 3. Okay, so phase 3 is basically phase 2. In terms of income, we still have the reduction of 500,000. And here, okay, so in program E, where the development budget was, we canceled a budget or a planned spending of 38,000 shekels for development of this program. We will have to postpone it to next year. And we decreased the training budget, which is here in activities, by 12,000, which means that, we have training until July. From July, we'll stop do training, and we will resume that in the next year. And once we did that, you can see that, first of all, here, the deviations. So now, when we look now at for example, at the deviation here, now this is not a real deviation because we decreased the budget. So here we can ignore the deviation because the deviation relates to an initial budget of 1 point whatever plus the 12,000. 7 months were spent based on this assumption, and then suddenly we decrease the budget. So now by definition the utilization rate will be higher compared to the standard utilization. But the most important thing is that now we have a bottom line of 154,000, which will be enough for us to continue with the year. Okay? So, and this is the final stage of the dynamic budget model. Update the expenses budget so that we eliminated the budgetary risk. And that is the most important point. Once we eliminated the budgetary risk, now we are certain that there is no budgetary risk. Obviously, until the next month, we have to check again. Then all the deviations that we see here, they reflect only cash flow risk. Specifically, if we go now to our income budget and we recheck it now under the knowledge that we do not have a budgetary risk anymore, but only a cash flow risk, then we should look, for example, on this deviation and ask ourselves, why do we have a delay in the government payment? And the lesson here, and I saw it happening again in one of the Israeli organizations that I advised, sometimes you have a delay in income because you forgot to ask for the money. It happens, we have flows of information that comes to us, and sometimes you just forget to send the letter. And in that case, you will have a cash flow risk. So again, the lesson here is once we eliminated the budgetary risk, which is the more serious risk, now we go back to our table and ask again, now we know that it's a cash flow risk, what are the reasons? Is it dependent on us because we forgot to ask, or we forgot to submit a report, or we forgot to do something technical in order to get the money, or there is another issue that we need to find out. But now we know that this entire table, all these deviations they reflect only cash flow risk and not a budgetary risk. And that basically closes the cycle. There is additional model of handling cash flow risk, but we don't have enough time to deal with it. But one thing I will tell you that will connect this material to what we have seen. The best way to avoid cash flow risk is to keep enough working capital, which means to have enough money in the bank so that these fluctuations or delays in income will not affect you. That is the most effective way to deal with cash flow risk. If you have an operating reserve which equals about 3 months of operation, you are not concerned by cash flow risk. You should be concerned by budgetary risk. And that's why it's important to each month to do this analysis and make sure that you don't have a budgetary risk. Budgetary risk can be even more significant than 3 months of operation. But if you eliminated the budgetary risk and you only have cash flow risk and you kept enough working capital aside, then you will be okay.